Did you know that you can actually make $50 easily? Not easily, but you can actually make $50 every day catching spikes as long as if you are trading with the trend. And I'm going to show you exactly how you can do this today. Right? You just need a few indicators and you're good to go. Even if you're a beginner, even if you're a pro trader, this strategy actually works for everyone. And you can combine it with any other strategy, especially if you are trading price action, right? So what's the strategy? The strategy you are just using the 50 EMA and the 13 EMA, right? So let me show you the settings, right? So over here, this is the 13 exponential moving average that I'm using, right? So just set it to these settings, 13 exponential, apply to close, and that's the red one, the red dotted one on my chart, right? And you click save, right? And the 50 moving average exponential again, and that's the blue one on my chart, right? So just copy these exactly as they are, right? And the 200, we actually don't need it. I can actually delete it right now, right? Because we're only going to be using those two indicators today, right? So these two indicators, how do you actually have to do this, right? So what you have to do first, right, is first you have to confirm the trend, right? The overall trend. Right. So over here, let's check Boom 500 for example. Right. So there are two ways of doing this. Right. So other ways, that's when we'll be using the 200 moving average, and I will show you in a bit. And first way is just simple price action. Right. So over here, you just have to wait for a breaking market structure, breaking market structure. So if it's boom, where we want to enter for spikes going on, going up. So wait for a breaking market structure to the upside, right? On the 15-minute, 5-minute, but we can just use the 5 minutes since we are not or we don't want to stay in the market for that long, so we can just use the 5 minute for our confirmation, right? So first of all, you have to confirm if the trend is in an uptrend, right? So this case over here, wait for the breaking market structure, right? After the breaking market structure, what do you have to do, right? So we have to wait for the what, for the candlesticks to pull back to the what, to the 50 moving average, right? And when they pull back to the 50 moving average, what do you have to do right now? So what you're waiting for is a spike, right? That spike's closing above the what, the 13 moving average over here, right? So when once you get a spike that closes above the 30 moving average, that's when you'll be able to enter your buys, right? But I don't want you to enter your buys when the 13 and the 50 have closed for a sale like this, right? Even if the spike closes above the 30 moving average and the trade eventually worked out, but usually it doesn't. I want you to avoid those because sometimes it can just be a small ID 50 back to the to the 50 moving average, and then it continues going down. And so what do you have to actually look for, right? So over here, there's an example of that, right? You are catching one, two spikes, and that's it, right? So the beauty of this strategy is you can actually drop down to the to the 1 minute time frame so that you can get sniper entries, right? And you will be able to to take bigger wins. And I'm going to show you exactly how you can even milk more with this strategy, right? So over here, what do you have to wait for, right? So we see a pullback to to the 50 moving average and a spike that closes above above the 13 moving average, right? And as you can see, uh if you entered over there, right, you didn't have to wait long and you got another spike, right? So over here, right? So what are the stop loss? How do you set your stop loss, right? So if your stop loss, right, you have to wait, right? So let's take this for example over here, right? We've got a pullback to the 50 moving average, a spike that closes above the 30 moving average. You take your positions over here, right? And if we get another close below the 13 moving average, then we'll close the trade, right? So this ensures that we are limiting our risks, right? And we won't lose as much money, right? So over here, let's take this for example, right? We entered over here, right? And we exit, maybe let's say this at close below over here, right? So this is your stop loss, right? And as you can see, we're targeting those highs. It's an easy 1 to 3 risk to reward ratio, right? So as you can see, this strategy is actually very effective, right? So over here, we're going to put back to the 50 moving average, right? And we spike, but we don't close above above the 30 moving average, so we don't get an entry, right? So as you can see, it's just a simple way of filtering and selecting the trades that you take, right? And remember, if you're not subscribed to this channel, you can actually support us by subscribing so that we'll be able to reach more people and I can be more fulfilled, right? So over here, let me show you an example on Crash 500, right? It's got a lot of examples, right? So over here, as you can see, we've got multiple examples. If you are scalping spikes, then this is just a simple way of doing it, right? And let's check Crash 500 over here, right? So over here, crash 500, as you can see. Uh, the conditions that we have to use is they are still the same, right? So right now, what I want to do for checking the trend, I want us to insert our 200 moving average, right? Put back the 200 moving average over here. Apply exponential, apply to close, right? And I want to make it purple. I'm just used to seeing my 200 moving average is purple, right? So that's the 200 moving average. So if it's crashed, what do we have to do? What you just have to do is it's just a simple way of seeing if the market is in a downtrend is if the 200 moving average is above your candlesticks, then it means we are in a downtrend. And if the 200 moving average is below what? Is below the candlesticks, it means that we're in an uptrend, right? So that's just how simple it is. That's as simple as it gets, right? Now for the conditions in order for you to what? To enter the trade, right? So over here, right? So let's take this for example, right? We've got to put back to the 50 moving average, a spike below what? That closes below the 30 moving average. You enter over here, right? Your stop loss is if the candle closes above what? Above the 13 moving average. And as you can see over here, it almost closed, but it didn't, right? And it continued what? Rallying back, right? So as you can see over here, it put back to 13 again, and it didn't close above. So if you could, you'd still be holding, right? And you only exit here when there's a close above what? Above the 30 moving average. So as you can see, if you entered somewhere over here, right, and you closed over here, right, you're risking something like this, right? So as you can see, this is a what? A larger risk to reward ratio, right? So it's an easy 50 bucks, depending on the lot size, of course, that you're using, the account size. But if you are using an average account of maybe let's say $100 or above, right, you'll be able to what? You'll be able to enter, right? So that's just how simple it gets. But so another way of actually making money with this, of but it's this now is high risk, right? So what you have to do is, let's say I want to enter a dollar lot, right? I want to enter a dollar lot on crash 500, right? I want to catch a spike, right? So right over here of the bet over here, right? I can enter maybe 30 cents, right? As soon as the candlestick touches the 50 moving average, right? And as the market moves against me, I can enter 20 cents, right? 20 cents, and I keep on adding what? Adding positions, right? So this now, right, you have the advantage that when the spike actually comes, you won't miss the spike, and you catch the initial move from the start, right? So that's the only advantage of this. But it's actually high risk because there are multiple examples when the market doesn't continue going, doesn't continue spiking, right? Let me check if there is such an example over here, right? So what I'm just saying is it's a high risk because let's say you enter over here, enter, you keep on entering, right? And you actually blow your account over there, right? And after blowing your account, imagine seeing the market going in your direction. That's just a bummer, right? So that's why I don't encourage that method, right? But yeah, that's just how simple it is, right? And if you want to combine this with price actions on flips, you can, right? So yeah, this is actually a good strategy, and it also works for ticks as well. It's just one and the same thing, right? So yeah, peace out. Remember, you are the bridge between where you are and where you want to be.